If they succeed in taking, they, meaning the big thinkers, the governments, succeed in taking nominal interest rates higher, the progress of gold will be slower. But I think now that gold really is on the path. It's worthy for your audience to note that this $2,000 gold price, while a record in nominal terms, is not a record in real terms, in the sense that it's measured against dollars, which have themselves deteriorated. So it's useful to understand that. It's useful to understand a couple of other things too. Historically, what's always driven the gold price more than anything else is people's concern about the maintenance of their purchasing power in more conventional savings instruments. And there is nothing that should worry savers more than interest rates which are insufficient to keep pace with inflation. The best illustration of this I know is the US 10-year Treasury, which will pay you 3.4% interest every year for 10 years in US dollars, in a currency which the US Congressional Budget Office says is losing 7% of its purchasing power a year. In other words, the arithmetic is that the US government guarantees to reduce your purchasing power by 3.5% a year, compounded for 10 years. The first promise made by the government that I'm prepared to believe that they will keep in my lifetime. It's important, too, to consider how far gold can go. The market share of precious metals and precious metals-related securities in the United States, the market I know best, is less than 0.5%, which is to say, precious metals-related investments comprise less than 0.5% of all savings and investment asset classes in the United States. The 4-decade mean market share is 2%. I believe that negative real interest rates, quantitative easing, debt and deficits combined will at least propel gold's market share to the 4-decade mean. If that's correct, demand for precious metals related assets will increase fourfold, which is precisely what I think is going to happen. Traditionally, gold bull markets are led by the big companies, and we've seen that happen this time. The move into gold, particularly from generalist investors, has concentrated among the equities in large cap names, which has almost always happened. So the lag in the small cap names relative to the large cap names can be expected. We're just now starting to see a mergers and acquisition cycle, which is usually what kicks off the juniors. It's important to know that this gold bull market is unlike some others in the sense that it's occurring consistently with a lagging market in equities generally, small cap equities generally. So the marginal equities, and there's nothing in the world more marginal than a non-revenue producing gold junior, have suffered disproportionately. I think it's important too to understand that investors need to be much more discriminating among their juniors. There are probably 2,000 mining juniors in the world, and I would suspect that not more than 300 of them are viable. Make no mistake, if gold continues higher and the majors continue higher, the juniors will get pulled along. It's happened 4 times before in my career. This follows a predictable pattern. The timing is uncertain, but my suspicion is that the outcome is inevitable, even if it isn't imminent. I am going to argue that the last 40 years, which is to say 1982 to 2002, were probably the most benign economic climate in the history of mankind. Declining real interest rates, a great demographic boom, massive inclusion around the world, great trade. And I think the benign economic climate that we've faced for the last 40 years is over, which means that banking has to change. 4 decades of relatively benign economic climate encouraged risk-taking with regards to liquidity at banks throughout North America, with the Canadian banks being notable exceptions. So many consumers have changed their deposits from regional and community banks in the United States to the big banks that they have encouraged the big banks to lower the interest rate that they pay. Depositors are in effect recapitalizing the bank by foregoing interest. Most of the big banks in the United States and all of the big banks in Canada will, if they can, get away with not paying you any interest on your checking account. This is insane. This is really, truly insane. Investors need to wake up and need to understand that the purchasing power of their deposits is declining at 7% compounded. The idea that you give somebody else the use of your money for no interest consigns you to a personal bank failure. Interest rates should be set by the market. The idea that it is the business of the Fed to manipulate interest rates is bad policy, but good politics. Listen, artificially low interest rates really constitute a war on savers by spenders. In a democracy, spenders are more numerous than savers. So artificially low interest rates, which is to say policies that penalize savers on spenders, penalize savers on behalf of spenders, are always going to be popular. But societies never get rich by spending. They get rich by saving. What should the Fed do? The Fed should get out of the way. What will they do? More of the same. My suspicion is that the period of higher interest rates that we have seen will lead to market disruption, as it had, and will eventually lead to economic disruption. When that happens, I suspect that the noise that you will hear from the political class will cause central bank officials in both countries to either moderate the increase in interest rates or lower interest rates. And if that happens, if the amount of interest received by depositors continues to decrease relative to the value of the spending power of their currencies, I think one of the outcomes that you will see will be increasing disintermediation from savings products into gold, a response mechanism that's been tried and succeeded for 2,000 years.